What happens when the dream of a gentle, predictable retirement filled with leisure, fun, and excitement turns into a high inflation nightmare? Unfortunately, this is exactly what happens to many retirees when they step into retirement, because they make a few bad choices. We're going to talk about what those are and how to avoid them next.
Holy Schmidt!
Picture this. You work for 40 years in a job that you don't like, or for an employer that you don't like, or for a company that you don't like, and you keep pushing because the income is important. It supports your family, it supports your lifestyle, and most importantly, it funds your retirement dream. But for many people, that dream never happens because they step into an inflation nightmare. Not because inflation is raging like 2022, but because they made a few bad choices based on some popular suggestions that are out there in the world. Those suggestions, unfortunately, are really retirement landmines. And if you don't identify those landmines, you can be in a very difficult situation. The data that we're going to talk about, by the way, comes from one place. It's the 2026 Morningstar Investment Conference, where there were several retirement experts on a panel who talked about this very subject. Ahead, I'll put the big ideas in the video, add some supporting government data, and add two other mistakes that didn't make it onto the list, but they are very important. All right, let's get into it. Number one, you downsize, but you downsize into a hotter, more expensive market. Let me explain. A lot of people downsize in retirement. It's a great idea. A smaller home, less upkeep, less maintenance, less things to worry about. But where you decide to move can undo the math. Let's say that you live in a community where housing prices are flat. They haven't gone up in years. Maybe they've even gone backwards. So you sell your big home and you find another home that's almost as expensive in a hot market, but it has the footprint of a good retirement home, less upkeep. And let's say that you're moving to New York, for example, New York City even. Your housing inflation just went up. Now, I'm not talking just about the price of the house. If you moved from a 4-bedroom home in Des Moines, Iowa, into a 2-bedroom condo in New York City, even if the price was flat, you have to contend with other things. Taxes, for example. And by the way, it's not just taxes. There's price inflation. If you look at the Bureau of Economic Analysis, New York has a multiplier of 1.10, Des Moines, Iowa, 0.95. The national average is 1.0. What that means is if you live in New York City, you're paying 110% of the national average for everything from a tube of toothpaste to a television. In Des Moines, Iowa, it would be 95%. That's roughly a 15% gap before you even look at housing. Housing, the gap is much wider. Now run a simple test. If you spent $50,000 a year on your stuff in your life and it increased by 15%, you've increased your spending by $7,500 a year for the rest of your life. And that's just on the things that you buy day to day. Let's say you didn't want to live in New York City, you wanted to live in San Francisco. That's 117% of the national average, not 110. And so the prices are even higher. And you need to watch the tax trap too, because if a state has no income tax, they have to pay the bills somehow. How do they do it? Usually with a sales tax of some sort. So you move from your humble Midwest life in a big home into a smaller home that costs almost as much, and you think you're good, only to find out that you have higher property taxes, higher sales tax, higher home insurance. The headline sounds cheap, but in reality, it's much more expensive. One simple guardrail here which will help you with this, because there are so many changes that happen when someone retires, and a lot of them happen simultaneously. Try renting for a year before you actually purchase anything, because that will help you determine the actual cost of living in the new community. The next point is that you assume that your spending will rise gradually with inflation, but the reality is spending is more nuanced in retirement. Financial planners see a clear pattern of retirees in retirement: go-go, slow-go, and no-go. In the go-go years, you spend more. In the slow-go years, you spend less. In the no-go years, you spend potentially more because you have healthcare costs that are a big part of the financial picture. And the problem, or the challenge anyway, with most financial plans is they don't account for go-go, slow-go, and no-go. They're a straight line spend. So you may hold back in the beginning years and spend less than you need to enjoy that portion of retirement. And then when you get to the middle, well, you have a lot of money that you're saving because the plan shows you what you can save and you're not spending that. And then when you get to the end, then you spend basically what you need to make sure that you have the healthcare coverage and other that you actually need in retirement. So the beginning years of retirement tend to be more expensive, maybe even substantially more expensive than a static plan will allow for. Speaking of planning for retirement, gang, if you're using spreadsheets to plan your retirement, you're doing it the old-fashioned way. Now on this channel, we have 3 affiliate relationships. One is Bolden Personal Financial Planning Software. That's the personal financial planning software that I personally use. With Bolden, you can look at different spending patterns, different inflation patterns, different investment return patterns. You can use a Monte Carlo simulation to tell you your probability of success. Roth conversions can be modeled, and a lot more. If this is of interest to you, you can use our affiliate link. Go to go.bolden.com/Schmidt to get 2 weeks free of their full featured software. If you decide to keep it after the 2 weeks, it's just $12 a month paid annually. Mistake number 3, ignoring inflation when it does hit. Now, this is something that a lot of people, not just retirees, are guilty of because inflation doesn't announce itself until it's already over or until you are deep in it anyway. And unfortunately, oftentimes you don't feel it when it's happening because everything doesn't adjust at one time. You feel it later and think, wow, everybody just raised their prices all of a sudden. But the reality is that people wait, companies wait. They don't adjust their price on schedule when inflation reports. Some do, some don't. And then when that adjustment happens, you really feel it like a hammer coming down. Now on this channel, we talk about something called sequence of return risk. And that basically means that it's a bad market for the first few years of retirement. And that changes your investments for the rest of your life because those first few years matter when it comes to how you spend. The same thing applies to inflation. Picture 2 retirements. Both average the same inflation over the years. In the first, prices rise 5% a year for the first 5 years, then 2% after that. In the second, prices rise 2% for the first 15 years, then 5% at the end. Same average, very different result. The first retiree needs almost 20% more savings. Let me put a number on that for you. If one plan needs $1 million, the early inflation version of the same retirement can need closer to $1.2 million. Same lifestyle, nearly $200,000 more, only because of timing. Why? Because a price increase early doesn't go away. It sits on top of future price increases. So early price increases you have to live with for the rest of your life. And as we just talked about, people tend to spend more in early retirement. And so if inflation is hitting hard in early retirement, you have a double whammy. It's much harder to recover from that. Now, here's the biggest part to all of this. You personally cannot control inflation. You can control what you spend on in inflationary times, but you can't control inflation. So if it happens early, that is completely out of your control. In other words, the first 5 to 10 years of retirement carry the biggest inflation risk. Number 4, you claim Social Security early instead of delaying it, and Social Security is arguably the single best way to protect yourself from inflation. Social Security has a cost of living adjustment built right in. You don't carry the inflation risk on that increase, the government does. Now, stack a second feature on top of that. For every year you wait past your full retirement age up until age 70, your benefit goes up 8% per year on top of the cost of living adjustment. And the opposite is also true. If you claim at age 62, your payment is 30% less than what you would receive at full retirement age. If you claim at 70, it's 24% higher than full retirement age. The difference between 62 and 70 isn't 54%, it's 77% because you're comparing the 62-year-old value versus the age 70 value. Now let's compare that 2.8% that we just talked about on the actual monthly payments. A Social Security payment of $2,000 a month with a 2.8% increase receives $56. That same 2.8% on a $3,500 a month payment is $98. Bigger base, bigger raise every year for life. And then there's the longevity part. Now, nothing's guaranteed, of course, but if you have a family history of people who live a long life and you are relatively healthy, there's a good chance that you could go past what's called the break-even point. This is the point where waiting actually means that you receive more money than claiming early. So before you buy any product to fight inflation, look at the one that you already have. Delaying claiming may be the best inflation deal that you have available to you. Number 5, you write off annuities because they don't have an inflation adjustment. There are a lot of reasons to buy annuities. There are a lot of reasons to not buy annuities. It depends on the nature of the annuity. But one of the most common comments about an annuity is that you don't want to buy an annuity because it doesn't have inflation protection. But ask yourself what your own bond portfolio looks like. Most people don't own TIPS, Treasury inflation-protected securities. They own bonds, corporate bonds, even Treasury bonds, which don't have inflation protection. We hold an insurance company who sells the annuities to a different standard than our own bond portfolios. And the fact is, the insurer is buying the same type of corporate bonds that you do, or your mutual fund does. And, importantly, there's a build-it-yourself fix. You don't need a rider on your annuity. Let me explain how that works. Start with a base of income now. Then add a delayed annuity that turns on at, say, 75. Maybe another that turns on at 85. Each one steps your income up as you age. This kind of delayed annuity even has a name. It's often called a longevity annuity, and one version can start paying as late as age 85. This gives you an upwardly sloping income path of your own design. You can make it 65, 75, 80. You can make it 65, 70, 85, some combination thereof. And there's a second reason this might work for you. If you're delaying Social Security, your later years already lean on that inflation-protected payment. A flat income layer on top of it looks a lot like real retirement spending, which tends to ease off after inflation anyway. And the trade-off is real. You give up some money up front to access the cash later. In return, you get income that you can't outlive. Think of it as buying your own pension, one piece at a time, on your own schedule. Gang, how prepared are you for retirement really? Many people think they're more prepared than they really are. That's why I created the 15-question retirement readiness quiz. It's absolutely free, no phone number, no credit card, nothing like that. If this is of interest to you, go to hollyschmidt.com/quiz, answer the 15 questions, and you'll get a 12-page report emailed to you instantly. You'll also be put on our list and get tips, tricks, and other information by email a couple of times a week. Point 6, you treat the inflation number as your actual inflation. Every month, a new inflation number hits the press. Now, that's not your inflation number, that's an average. That's the average inflation in the United States. It's a basket, it's a young renter, it's a family with kids, it's a retiree. It's all of them, and it's the average of all of them. Now, your basket is going to be different. Retirees spend more money on the category that is rising fastest, and that's healthcare. And healthcare inflation isn't just inflation for doctor visits. It's your Medicare supplement premium. It's the IRMA surcharge if you earn too much. It's your prescription drug costs. And for a lot of people, it's long-term care. Look at the size of it. Fidelity estimates a 65-year-old retiree in 2026 will spend about $185,500 on health care over their retirement. Now compare that to Social Security. In 2026, the increase was 2.8%. In retirement, your biggest cost is climbing faster than Social Security. It's climbing faster than inflation. So if you're planning around the headline number, you may be planning around a level that you actually can't achieve. The fix is to build your own personal inflation rate. Start with your actual spending. If a big slice goes to premiums and prescriptions, weigh it towards healthcare. Your number will likely run above the headline. And you don't need a spreadsheet filled with math. Just be honest with yourself and look at where you're spending now and where you think you're going to be spending in the future. Now, there's a common thread that runs through all 6 of these points. The average is not your experience, not the average inflation over time, not the average price across the country, not the average basket of goods. Plan for your timing, your location, and your spending. That's how you keep inflation from multiplying on you. Now, let me help you pull this together with an action plan. First, in retirement, expect a spending curve, not a straight line. More in the go-go years, less later. Second, protect your first 5 to 10 years, the hardest, because early inflation is the kind that multiplies. Third, if your health allows, delay Social Security for an inflation-protected raise on a bigger base. Fourth, one strategy you can utilize is build bigger income with delayed annuities. Fifth, and very importantly, if you plan on relocating, don't plan on just the difference in the price of the home. Cost everything, because your local costs could be higher, may be higher than your current costs. Finally, plan around your own inflation rate, not the reported inflation rate. And it would be wise to skew it towards additional healthcare costs. If you like this video, check out that video, 5 expenses retirees can cut without even feeling it. Also, don't forget to check out Bolden. Go to go.bolden.com/Schmidt to get your 2 weeks free. This is Jeff Schmidt, and I will see you in that video right there.